everyone, and thank you for tuning into this update. I'm Joshua Dobi. Appreciate so much your willingness to take a few minutes here to give some consideration towards some of the things that we're seeing in the market right now, and because I want to be respectful of your time, I'm going to dive right in and get right to it. Two things I'd really like to focus on in this update here, and they're very much interrelated, and yes, they are going to be very much the kinds of things that you're probably seeing on your news screens. One has to do with market performance, especially some of the negative volatility that we have seen here recently, and the second has to do with interest rates. If you're watching any business news program, reading any business section of the newspaper right now or the Wall Street Journal, you are seeing an awful lot on interest rates. So we're going to talk about that. So let's start there with interest rates. And the reason for that is, at the time of this recording, the Federal Reserve Board just increased what we call the overnight lending rate, which is a base rate used for lending money from the Federal Reserve to its member banks, or most of the banks with which we're familiar around the country. And then from there is a domino effect in terms of how other interest rates are calculated. So they just raised the overnight lending rate by 75 basis points, or 0.75% as of this afternoon, about the time of this recording. So why is that significant? Well, the first reason why that's significant is that's the largest single increase that the Federal Reserve Board has done in almost 30 years. 1994 was the last time that we had anything of that size done at a single meeting. Usually it's 0.25% or 25 basis points. Every once in a while it's 50 basis points or 0.5%. That's what the Federal Reserve Board did at the last meeting. And then very rarely, and we had it happen today, we have a 75 basis point move, an increase in interest rates. So you know me, I'm a practical and pretty simple person. So what does that mean? So we have the overnight lending rate increasing. What does that mean? Well, frankly, you're probably experiencing some of the effects of it right now, and you're certainly experiencing it if you're applying for a mortgage, if you're applying for a car loan, if you're applying for a line of credit, if you're a small business, or if you're looking to buy a piece of property as a business owner or an investment piece of property. You're experiencing it because you're seeing rates increase significantly, especially, just since the first of this year, so not even 6 months ago. I'll give you a quick example. Right around the end of last year, I'm not going to be specific on the date on it, but right around the end of last year, you could get a fixed rate mortgage for roughly 3.5 to 3.75%, fixed 30-year fixed mortgage. Now, if you're going to do the same thing, I just looked at one this past week, you're bumping into 6%. In terms of the interest rate. So a very, very different environment when you're looking at the difference between 3.5 and 6% when you're looking at a residential mortgage. We're seeing that also on the commercial end of things. We're seeing it with regards to car loans and all manner. So you see that on that end of things. Now, on the other side of that seesaw, we should also at some point, although this tends to lag, we should also begin to see an increase in our savings accounts and money market account interest rates, or the interest that our deposits actually earn. Now, if you're like me, you remember those days when they paid 3, 4, 5% just to have money sitting in a savings account or a money market account or a short-term CD, all of those good kinds of things. Haven't been there for many, many years. And I'm not saying we're going to immediately go back there, but we're definitely going to start to see a little bit of an increase here over the next year or so. Finally, in terms of the interest that we're receiving on our deposit accounts. So you kind of get two ends of the seesaw there. Increase in capital expenditure costs for loans, specifically residential mortgages, car loans, business lines of credit, business real estate. But also we should be seeing here a little bit more in a lagging kind of way, an increase in money market rates, interest, CD rates, and those good kinds of things. So it's a very important item to keep in mind. But then a question that often follows right after that is, and this has come up a lot for many of you, why is the Federal Reserve Board raising rates at all? It's a great question. And there is really not a legitimate binary answer to that. I could give you just one factor and say, this is it. It's not true. There are literally dozens of factors that the Federal Reserve Board takes into account when it looks at either increasing or decreasing the overnight lending rate. But I'm going to give you a couple of macro factors here because these absolutely are important for you to keep in mind. The first is, and I don't mean this to sound ugly or to be any way disrespectful to the Federal Reserve Board, but by their quick movement here over the last couple of months, what they are implicitly saying is that they missed the idea, meaning they missed where the economy is with regards to a need for where interest rates are supposed to be. Put another way, we shouldn't have to increase this fast. In normal kinds of conditions, we shouldn't have to increase the overnight lending rate so much in such a short period of time. But one of the reasons for that, one of the big reasons for that, again, like I said, not the only reason, dozens of variables in this algorithm, but one of the primary reasons for that is because of where inflation is at this time. If you watch inflation like I do, I hope you don't watch it like I do, but if you do watch inflation like I do, we just had a print last week of over 8%, actually 8.6% annualized as of last week. That's outrageous from an inflationary standpoint. Certainly when we're looking at history, it's almost hard to compute that. And what makes that even more challenging is the more volatile aspects of that figure, food and energy, think grocery store, gasoline pump for most of us, that's where we're seeing those kinds of impacts. It's double digits year over year, meaning north of 10% in terms of increase year over year. So the primary weapon that the Federal Reserve Board has to be able to tamp down on inflation is to increase interest rates. And I know this might seem a little bit counterintuitive, but literally, from your economics classes in college, the Federal Reserve Board then uses the weapon of increasing interest rates, frankly, to tamp down on demand and to tamp down on spending in the economy in order to bring inflation down. I know that doesn't sound like a very good mechanism, and yes, it is very much a broad-based sword, but that's primarily what the Federal Reserve, literally coming from Chairman Jay Powell's own words, that's what their primary focus is and what they're trying to do. So what does that mean? So as interest rates increase, and let's say we're going to get some reduction in inflation, there are going to be other effects as well. These are, like I said, this is not a binary kind of movement. There are other effects that are going to be happening from this as well. I would expect to see at a certain point an uptick in the unemployment rate. Does that mean it's going to ramp up? We're going to have widespread unemployment? I'm not saying that at all. Actually, I don't expect that will be the case. But we probably are going to see an uptick in the unemployment rate. We probably are going to see folks also start to adjust their spending. Frankly, in the things that I'm watching here, they already are starting to do that. Folks are driving less already, even coming into the summer driving season and vacations and all those kinds of things. We're already starting to see folks driving less because of the high price of a gallon of gasoline. We're starting to see folks who are adjusting their buying habits in grocery stores, meaning specifically, if they were normally buying product A, they're looking for substitute B or C, perhaps in their place, so where they don't have to pay as much for that, let's call it near kind of experience or near kind of product in doing that. So we're already starting to see that. I anticipate we're going to continue to see that in more significant ways here over the next several months to a year. Several other factors that are in motion as well. I'm just going to use this because it's an easy target. So we got oil over here, which is rapidly rising through $120 a barrel for West Texas Intermediate, which is the benchmark here in the United States. We have that rising, but then over here we have lumber, meaning raw lumber, which is a commodity and is something which is obviously used extensively in the building industry and like kinds of means, has fallen precipitously here over the last several months. And one of the reasons for that, again, not a binary kind of experience, but one of the reasons for that is because there has been a steady decrease in the number of new building permits requested and also in terms of the number of folks who are still looking for homes. Now, if you're looking for a home right now, you may not be experiencing this at all yet. I get it, because in so many parts around the country, it's still a very hot real estate market. But we're just starting to see the ebb, or we're just starting, I don't want to say it's a crest, but it definitely is a different direction in terms of where residential housing is. Frankly, because folks, and this always happens, folks get to a space, and you heard me say this in a previous update, where they're simply not going to continuously pay above market. They do so for a while. That causes us to get into some of the challenges that we have in the residential real estate market. But at a certain point, somebody says, I'm not going to pay that high price. And then somebody behind them says, neither am I. And the person behind them says, neither am I. And you get enough people who say that, and you're actually going to change the market. So we're already starting to see those kinds of things right now. So coming back to the economics lesson, if I didn't lose you too quickly there. So as with an increase in interest rates, generally speaking, you're going to see a tampering down of inflation. And that is what's desired insofar as the Federal Reserve is concerned. And for all of us, experientially, we want for that to be the case as well. But what happens with that increase in interest rates is not just tamping down on inflation, but again, usually also some upticks in unemployment and some decreases in corporate spending. So what that can mean is that folks aren't going to be hiring as much. They may not be looking to expand as much because the cost of capital is increasing. They may not be looking to make the acquisitions that they were looking to make previously because it's just more expensive to do so. So again, a number of things to keep in mind there whenever we're looking at what an increase in interest rates mean. All right, so I've given you all of that econ lesson. I hope you're still with me here. How does that all correlate to the markets? Well, again, just like I've been saying, it's not a binary kind of exercise. It's not the kind of thing we can say, oh, interest rates go up, bad for the market. No, that's really not just that binary of a relationship. It may seem that way because certainly in the first 5.5 months of this year, it has felt that way as interest rates are going up, that somehow there's a direct correlation to negative performance in the markets. And again, without getting too far off the track here, but in terms of valuation models for certain individual stocks, they absolutely use the 10-year Treasury bond interest rate as part of their valuation model in determining what's a fair price for a particular stock, especially for more aggressive or sometimes more tech-oriented companies. Meaning to say, when interest rates are lower, some valuation models will indicate that a fair price for an aggressive growth company or a tech company sometimes should be higher. And then the inverse happens. And we're seeing that in the more aggressive ends of the stock market. Interest rates rising, a lot of those valuation models then say, well, where we thought this company was valued here, meaning in terms of share price, now we believe it's valued here. And so we're seeing that really ripple through the market. The market's trying to get an idea about where the landing space is going to be relative to interest rates so that they can get a better feeling for where these more aggressive growth companies should actually land in terms of pricing. So that's part of that negative volatility that we're seeing pretty constantly in the market right now. And it's, some days are up huge, other days are down huge. The last couple of weeks have really been just really unpleasant as the market is trying to figure out how all of these variables go together. But one of the misnomers that I want to really bring to your attention here, and I say misnomers because I drew it out in terms of interest rates going higher, inflation going higher, market goes lower. I've heard that a lot here over the last several months from any number of sources. Folks, that's just plain not true. There are plenty of instances in our history when we look at the stock market performance where certain sectors, certain companies have done just fine because of how they're built. I'm going to use one sector just because it's an easy target during this time, oil and energy companies. I'm not saying that every oil and energy company is doing perfectly well right now or that everyone has had a fabulous year, but take a look at some of the big names that are out there. They're not looking at recession. They're not looking at the kinds of things that are pulling back in terms of their business models. As a matter of fact, if you look at their stock prices, many of them, again, not all of them, have had fabulous years. Very often as well, hasn't been the case yet, but it probably will come in a more lagging kind of way. Financials. Yes, money center banks, but also regional banks as well, and sometimes even community banks, which are publicly traded, tend to do very well. Those kinds of financial institutions, which are more focused on deposits and loans, or savings and loans kinds of institutions, which tend to do very well in a rising interest rate environment because their margins increase. And so that gives them a larger possibility for profit. So those are just two very quick ones that I want to raise to your attention. Not making a recommendation to own energy companies, not making a recommendation to own financial companies, but just to say, especially when you take a look at history and understanding how things move during these kinds of periods, those definitely are a couple of the ones that you want to keep in mind that tend to do reasonably well. Also, side note, technology companies, in a lagging kind of way, tend to do well also, at least the good ones do, because the really good ones tend to have pricing power. If they're not in a commodity base or commodity structure kind of industry, it actually could be an opportunity for them to increase margins during this time as well. That's a sidebar. We'll probably be talking about that about a year from now or so, but definitely something to keep in mind. Well, I said those were two items. I've taken a lot of your time here in giving you this update. I appreciate your willingness to take the time to listen to what I have to say here. The bottom line to all of this is we expect to go through times like this. This is not unusual. This is not something that has never happened before or something that, I'll just tell you in advance, it's going to happen again at some point in the future as well. So we expect for these kinds of things to happen. It's not a reason to radically change things. It can be a reason to tweak. It can be a reason to shift. It can be a reason to either look at opportunity or to make some adjustments in your portfolio or not. It doesn't necessarily mean anything that the fact that the market has gone down, that you should automatically make changes. Every single person's situation and place is unique, And it's very, very important that you look at it that way. We certainly do here. If you'd like to reach out to us, anytime. I love to hear from you. Happy to chat about your portfolio. Happy to chat about this craziness that we're seeing in the markets. I'll try to make sense out of what the Federal Reserve Board is doing if you want to go down that path. I'd also like to hear about the more fun stuff. It is that summer season. If you're traveling again, perhaps for the first time in a while, I'd love to hear about that kind of stuff. Kids playing baseball, grandkids who are doing swim or gymnastics, all that kind of stuff. I enjoy the heck out of that stuff as well. So please always feel free to share that on my end of things and let me know how things are going. Well, friends, again, I appreciate so much your time here. Anytime, always feel free to reach out to us. We always love to hear from you. And until the next time, I look forward to talking with you soon.